Ladies and gentlemen, good day and welcome to Birlasoft Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Jadhav from Birlasoft. Thank you, and over to you, sir.
Thank you, Tanvi. So good evening to everyone. This is Vikas from Investor Relations team, and joining us on this call, we have our CEO and MD, Mr. Dharmendra Kapoor, DK as we call him, CFO, Mr. Chandrasekhar Tyagarajan, Chandru as we call him, Mr. Roop Singh, who is our Chief Business Officer, Mr. Sri Rangnath Kulkarni, SK as we call him, our Chief Delivery Officer, and we have also Mr. Arun Rao, who is our Chief People Officer. So we'll begin the call with opening remarks from Mr. Kapoor. So please note that anything that we say on this call on the company's outlook for the future is a forward-looking statement and must be read in conjunction with the disclaimer mentioned in our Q1 FY23 investor update, which has been sent to you and also uploaded on the stock exchanges. So with this, I'll now hand over the call to DK. Over to you, DK.
Thank you, Vikas. Good evening and welcome to Birlasoft's first quarter financial year 22-23 earning call. We have begun the new financial year on a steady note. Q1 revenue was at $148.6 million, registering a sequential growth of 1.5% and a year-on-year growth of 15.8%. Sequential growth in constant currency terms was at 2.3% and year-on-year constant currency growth was at 17.7% for quarter one. New deal momentum continues to be good with wins of $112 million in Q1, which is up by 19% in a year-on-year basis. The total TCV wins were also healthy at $185.1 million. EBITDA margin stood at 14.7%. We have seen margin getting impacted due to high cost hiring and mid and junior level promotions, drop in utilization, investments and were aided by rupee depreciation. We have switched to reporting attrition, which is more in line with the industry and factors early attrition. The good news is that we have seen a drop in our LTM attrition number, which fell from 29.4% in Q4 to 27.9% in Q1, a drop of about 150 BPS. However, needless to mention, it still remains elevated and we expect to see a further drop going ahead, which will help support margins going ahead. PAT stood at 15.5 million and was up 0.7% year-on-year and down 12% quarter-on-quarter. INR PAT was at rupees 121 crores, up 6.2% year-on-year and down 9.2% year-on-year. 6.2% I think quarter-on-quarter. In verticals, the growth was led by BFSI and manufacturing verticals. BFSI saw a growth of 5.1% quarter-on-quarter and 17.9% year-on-year, while manufacturing was up 2.8% quarter-on-quarter and 22.4% year-on-year. Horizontal growth was led by business and technology transformation services, which saw a growth of 7.4% quarter-on-quarter and 20.7% year-on-year. That clearly shows that slowly and surely we are becoming enterprise digital company and our revenue around digital is growing faster than the traditional services. Growth continues to be driven by larger accounts with top 5, top 10 and top 20 customers growing at 16.5% and 22.7% quarter-on-quarter and 21% on a year-on-year basis respectively. Our year-on-year customer count of 5 million plus revenue improved by 3 and that of 1 million plus improved by 5. Active customer count remains steady at 300. The headcount at end of Q1 stood at 12,565 and saw an addition of 361 professionals quarter-on-quarter and the addition of 1,057 professionals on a year-on-year basis. We have hired the 280 freshers in Q1 and plan to hire 500 freshers in Q2. Birlasoft continues to get various recognitions. It was named again as a top 15 sourcing standout by IHG and among the leading providers in the booming 15 category globally, as well as for the Americas region based on annual contract value won over the last 12 months. This is the 9th consecutive time that Birlasoft has been featured across named categories by ISG. During the quarter, Birlasoft adopted the RISE with SAP to transform its global landscape on the cloud. With enterprises adopting a cloud-first strategy, this move will enable Birlasoft to accelerate their clients' transformation journey substantially. Most of the clients today are already looking at modernizing their ERPs, especially SAP, and SAP on RISE is definitely a promising one, and we are very happy that we are the first few who have moved to a RISE, and I think that will help us go and take those opportunities in the market very, very confidently. In conclusion, I would reiterate that the IT demand outlook over the next 3 years looks healthy, despite some of the recession challenges. However, opportunities are multifold, especially in digital and cloud ecosystem, which augurs well for Birlasoft. We continue to remain optimistic and are well positioned on capitalizing the growth opportunities. With this, I would like to open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, to ask a question, you may enter star and one. We will wait for a moment while the question queue assembles. The first question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. DK, I think the Q4 result has come late on 24th of May, and during that day we were bullish both in terms of near-term growth as well as for FY 2023 kind of a growth. We were also expecting utilization to remain more or less stable. On all these counts, looking at the 1Q result, again being soft, where are we going wrong in terms of execution and even predicting the near-term earnings visibility or predictability?
Yeah, thank you, Sandeep. No, I don't think that we are going wrong anywhere, but I think there are few reasons that are to be looked at considering the situation that is there. I think the first big reason was that there is a delayed start on a couple of engagements that we have won. there are going to be more headwinds during the quarter two. As you know that we will have to give the increments, but there are some of the levers that we are already working on so that we remain at least flat or do a little better than what we have done in this quarter one. So that's the plan that we do. It is a steep improvement that we want to bring in. There is a huge amount of focus that is there on improving our margins, and I would like to, at least for the Q2, I would like to remain flat or improve a little bit on top of that. But then in the Q3, by that time there are other, productivity levers and all that will kick in, and probably we will improve in the quarter 3 and quarter 4 again then, so that we deliver more than 15%. Okay, but this quarter came with a significant higher, headwinds, for simple reason that we did not get the revenue that we thought, as I explained earlier, and whereas we had taken the cost already. So that was a little bit of a disappointment in the delays that we saw, but we are not seeing this with the other clients, so it is not widespread. It is only focused in 1 or 2 clients only. Okay. And just last question to Mr. Chandru. Just on the DSO, if I look at the absolute increase in US dollar sales is $2.3 million, while your debtor increase is as big as $7 to $7.3 million, and including unbilled, the total increase is $11.3 million. And we have reported a flat DSO on a Q1Q. So I'm still confused how this calculation is arrived at.
Yeah, so Sandeep, firstly, the DSO is billed DSO. So to that extent, the calculation is correct, because DSO is obviously a function of the rolling 3 months, the debtors as a function of the rolling 3 months revenue, right? So the DSO number is correct. To your question on the absolute increase in DSO, there are 2 parts to it. One is, of course, for the forex translation difference cost about 45% of the increase, right? And the balance of 5% was the real increase in the absolute number of receivable, the billed receivables coming from the increased revenue that we've seen over the past 2 quarters. So in essence, therefore, the DSO number of 58 is in relation to the receivables as a function of the average revenue. Now, our unbilled also in real terms have gone up, but if you look at it as a percentage of revenue, they're still staying flat, on a quarter-on-quarter basis. So these are 2 metrics that we watch fairly closely. Let me also tell you that there were 2 clients that delayed payment. The payment actually came on the 2nd of July versus the last week of June. That could have actually reduced my DSO from 58 down to 55, but it does happen sometimes, right?
Okay. I will come in a follow-up. Thanks.
Thank you. The next question is from the line of Shraddha from AMSEC. Please go ahead.
Yeah, hi. DK, couple of questions. First, if I look at your other expenses, that has seen a significant increase of 10%. So what has gone in the other expenses, your line item?
Shraddha, I will take this question, Chandru here. So the other expenses have a couple of components, right? So one is the subcontractor payouts that still, accounts, for a big portion of the other expenses. While we've seen a marginal reduction in subcontractors because we've started to replace them with regular employees, we still have to accelerate that pace as we are able to get more people, more regular resources deployed again, subcontractors both on-site and offshore, primarily on-site. So that is one area. 2, also as part of our, part of our growth strategy, we continue to as part of our growth strategy, we continue to invest in newer areas. One of the things is around hiring talent, hiring capability. Some of that, the cost of hiring goes into the other expenses, while the resources themselves are part of the part of the salary expenses. The cost of hiring goes into other expenses, and we continue to look at the cost of hiring, staying where it is. While we spoke about reduced attrition, we are also ramping up for additional growth in the coming quarters, right? Like DK spoke about. So that gets accounted for. And the third item that gets accounted for here is that we have engaged third parties to work with us on our billion-dollar strategy, and that's also a set of costs that we've been incurring for our growth, as we spoke about the investments that we continue to do. So that's the third item.
Would it be possible, sir, to call out the one-off expense in this quarter, the consultant charges that you paid, which will probably not get repeated in the next quarter?
Shraddha, there are some ongoing costs that will come for the next 3 to 4 quarters. So, to be honest with you, there will be some repeat costs we will incur in the second quarter as well. So, in that sense, I wouldn't call it one-off.
Right. Then you mentioned that subcontractor expenses were high, but if I look at that number, it was almost 15.8% of our revenue last quarter. Is it possible to give out the percentage number for this quarter so that we know where directionally are we headed there?
I will get back to you on that, Shraddha. Give me some time.
And sir, related question is your other unallocated expenditure. That item remains very high at almost 10% of revenue, other unallocable expenses. So what basically goes into that line item?
Yeah, I'll come back to both of these questions, Shraddha. I'll get the answers while we work through the rest of it. Okay.
Sure, sir. Thanks. And so, DK, to you, our cloud services, though we have been talking very positively on this service line, but that saw a decline in this quarter. So, how do we read that? And also, the deal TCV number was soft on a Q-on-Q basis. So, both these questions, if you can take up.
Yeah. So on the cloud side, absolutely, one of the work that is going on the strategy for $1 billion. One is actually around the cloud. In fact, with the cloud, we are seeing significant traction. So a little bit of up and down with the quarter. I don't think that should be seen as a trend, because with the cloud, we are going to definitely grow significantly higher than the rest of the traditional services. You would have seen now we have joined hands with Google also, and after that we made 2 wins as well along with Google, and there's a significant amount of focus is there on to set up a new GTM, keeping in mind the partners with Microsoft as well as with Google and AWS. So on the cloud side, I am absolutely upbeat that the revenue for us is going to grow. In fact, if we look at even today, we are very much at par with what we see with the industry. But being a smaller company, they are already on the cloud and what more can be achieved, because there is a lot of transformation that happens once someone moves to the cloud. So now we have broadened our horizon from that perspective. So what we are doing is we are picking up cloud as the bucket, okay, and we are looking at what kind of services can be there at various stages, starting from the consulting to the migration to the modernization and then finally transforming. Okay, so we are looking at what could be the offerings and how do we go and address every offering rather than trying to restrict ourselves only to fewer offerings and going there. Now that we have a significant amount of cloud revenue with us, we believe that we are in a good position where we can actually participate in the transformation program also for our customers, and that is the focus that we are working on.
Sure, got it. That was from my side. Thank you.
Thank you.
Thank you.
The next question is from the line of Abhishek Shandarkar from InCred Capital. Please go ahead.
Hi, thanks for the opportunity and congrats on a good quarter. Sir, I think I heard you that one of the challenges in the customer impacted the cloud and base services business. If you can just highlight, was there any enterprise solutions related work there as well? That is one. And from a vertical standpoint, is it largely reflected in the energy and life sciences vertical? Or, the manufacturing piece is also witnessing the moderation because of these customer-specific issues?
Yeah. So I talked about the two clients. One of the clients is purely enterprise solutions. One of the client, okay? The other client has a smaller piece, but because it is more into the kind of total IT outsourcing, so definitely enterprise solution is also a piece, but a smaller piece. But the other engagement that I talked about, it is purely the transformation program on the enterprise solution side. So yes, if I put it together, both of them, about 50% of that will actually be enterprise solution.
Okay, great. We understand in the past we've been highlighting that the enterprise recovery which started in the H2 of fiscal 22 might continue in fiscal 23. So based on your assessment and what you saw recently, do you think that the enterprise projects that we had run a risk where, some of them may get delayed or, there could be some other instances? Any color on, that side could be really helpful.
During the COVID time, yes, it was, it became a binary situation where somebody clearly said that, no, I don't think that we should take up the project. Okay, and then they kind of stopped it at that point of time, not for the reason of the investments and all that, but for the reasons that even the talent was not available on site for them to really execute those projects, because most of those projects will actually begin with a lot of planning and consulting where you require on-site presence along with the customer. It is very different now actually when we look at going forward, when the discussion is on the slowdown or on the recession or something like that. Because, I always believe that there is always a blessing in disguise for IT services when we talk about the recession. But at the same time, the sentiments are sentiments and it also have their own impact. What I believe is that one thing everybody has realized is that they need to adopt digitalization in a very stronger way and in a faster way. So that is no more if and but. It is all about that, a matter of survival. But the biggest question that all those are asking is that will I succeed with the digitalization if I do not modernize my SAP, my Oracle, my JDE or my other ERP or enterprise solutions below that? So what is happening is that they have realized during this time that they will need to take the underlying transformation also if they want to get the right benefits from the digitalization, because you can very easily imagine that most of the data and the processes lie within the enterprise solutions. And when you have to get the digitalization done, you need to invoke the value of the processes and the data that lies in the enterprise solution. So they definitely want to continue to modernize. They want to continue to go ahead. That's the discussion that I am seeing most of the time. Nobody's saying that no, right now we will not drop and now we will only look at doing it in the next year. So far, that discussion is not coming up.
Great, sir. Thank you for a detailed explanation. Thank you and best wishes.
Thank you.
Thank you.
Yeah. Sorry to interrupt. There was a question from Shraddha Agarwal. I just thought I will respond to the two outstanding questions. Right? So one was subcontractor expenses. The question was, what is the percentage to revenue in Q1? The percentage of revenue in Q1 was kind of flat quarter to quarter, Shraddha, at the overall level. Like I said, we've started to see a reduction at the end of the quarter, so we should see improvement in the second quarter. The unallocated expenses in the segment report relate primarily to SG&A, which is our selling general admin expenses. It also has, spend on our practice, the practice leaders and practice estimates that we have hired in the first quarter.
Sure. Thank you, sir. Should we move to the next question? The next question is from the line of Sameer Dosani from ICICI Prudential AMC. Please go ahead.
Hi, DK. Thanks for the opportunity. Just want to understand this 15 to 20 million deals, the two deals that we have signed. Want to understand how big is the tenure of these two deals, and as you said, right, this got delayed in Q1. So as of date or mid of this quarter, have this projects actually started ramping up in your view, or how? If you can.
Yeah. You're talking about the two deals, or you're talking about the overall deal win?
No, two deals that we have seen delay,
okay,
in which we have experienced delay.
Sure. Sorry, your voice was a little bit not clear. Hence, I asked for the repeat, but I understood. So on the two deals, one of the deal is for about 1.5 years, 1 to 1.5 years. That's the time frame that we see. The other deal, which is total IT outsourcing, this is for the 3 years.
Okay, thanks. And second is on the margins, right? We have delivered 13% EBIT margins, and Q2 would have some wage hikes where you'll probably are saying it would be flat or maybe some improvement. But to get and improve your margins on a year-on-year basis for FY23, you will have to substantially take up your margins, maybe even more than 15%, which you have delivered last year, right? So how do you think that journey will be for us? How confident are we around that number?
Yeah.
Also,
there are
squeezing one more point that we have started a quarter with 2 to 3% kind of dollar growth, CC growth, to reach up to 15 or deliver more than 15-16%, what we delivered last quarter, would need right 4 to 5% growth for next 3 quarters. So how confident are you around both these numbers? If you can just speak about that. Thanks.
Yeah. So on the margin side, as I told you that in this quarter, we had some revenue normalization that we had to do and some delays that also happened and all that. Okay, and that tells me that I think we want to continue to really look at much better growth in the rest of the quarter, and that is what we are gunning for. We don't give the guidance, as you know, but definitely the plan is to do much better than what we have done in this quarter.
But do we stay with the overall, directional picture that would be able to deliver better growth than FY22 and better margins than FY22?
So my view will be it will be in the ballpark. Okay, that is what I see. But a lot, I think, which is being talked about, you would have seen, in the industry wide, there is a lot of talk about that. And there are different views about the recession. There are different views about the budgets that clients are going to come up and the adoption of the technology that they want to go for. Okay, so everybody is coming up with those kind of plans. My view would be that how do we do same or a little better than what we did in the previous year?
Right. No, that's fair. We can't control the macros that
correct
that are evolving. Fair enough. Also, we have spoken about a lot around that how recession or downturn would be much better for IT as a sector. But can you throw some light there because what happens is the scale players benefit more than but obviously times have changed in the last 2 years. So can you throw some lights around the capabilities that we would have built that will help us actually take the benefit of the downturn like the scale players do usually? Can you just throw some lights around that? Thanks.
Yeah. So I don't think capability in addressing the opportunities is an issue. Okay, I don't think that is an issue, but we need to look at from the ecosystem perspective. For example, one of the major focus that we have right now is that how do we improve the talent supply chain. For example, we focus on the talent acquisition for a very long time, but with the twist that is there with the talent availability and the resignations or the attrition, and also this work from home, somehow these 6 to 9 months had been a perfect storm. Okay, that nobody wanted to really see in their lifetime, but then it always happens. That we get to see unexpected in the market. So when that period is going on, we have looked at one thing, that what if that now the recession is there, and when we come out of the recession, we get into similar situation again at that point of time. Okay, let us assume the recession is there, and from quarter 3, quarter 4, quarter 5, for a couple of quarters, we see the slowdown, and it impacts everybody. But when we are coming out of the recession, we should not be saying sorry to ourselves at that point of time, that we should have anticipated the higher growth or steep growth at that point of time. So it is not about getting ready only for this and next quarter. It is also about getting ready 6 or 7 quarters down the line, that if there is again a steep demand that we encounter, we should be able to manage the talent supply chain in a much, much better way. And that's the reason our intake on freshers is much higher. Our intake on the juniors is very higher. We are spending money on the learning and development. Okay, we are spending money on various other initiatives so that we are able to address this better if we confront the situation, let's say 3-4 quarters down the line again. It is a more long-term solution. I did talk about in the previous meetings also that we need to work on the longer-term solution. Okay, so even if we have to sacrifice a little bit of my margin now so that I get much better benefit in the future, we should do that, because that would be the right approach in order for us to have a predictable revenue and margin.
Right, DK. It will actually help us scale up. Thanks. I think one question got unanswered was, are those 2 contracts which were delayed has started ramping up as we speak, or is it yet to actually ramp start for us?
For that, we already did the ramp up actually. It is only that now we need to deploy and work on those because, and the work on one of them is already actually started and all that. So that we did the deployment in the previous quarter itself. Okay. It is just that it did not start and it ended up hitting our utilization and the margin, and of course the revenue as well.
So one contract started at the end of Q1 and second is yet to start.
That's right, yeah.
Good luck to your team, DK. Thanks.
Thank you very much.
Thank you. The next question is from the line of Dipesh Mehta from MK Global. Please go ahead.
Yeah, thanks for the opportunity. DK, a couple of questions. Starting with the deal pipeline, if you can help us understand how the deal pipeline is shaping up. I think earlier you used to give some number. So if you can provide deal pipeline number at the end of Q1 and give some comparable number, maybe QOQ, YY, whichever way you are comfortable with. Second question is about the revenue normalization, which you earlier alluded, which partly explained weakness in Q1. Can you provide some more detail on it? What you mean by revenue normalization and which vertical is largely you refer to, whether a life science is what you are referring to, and how you expect it to evolve over next few quarters? Yeah. Third question is about the Microsoft relationship. I think earlier, a couple of quarters back, you indicated 100 million aspiration by FY24. So if you can provide some update where we are in that journey from that relationship and how it is scaling up. And last question for Chandru is about the OCF. OCF remained weak this quarter. It was negative. So if you can provide some sense, what explains it? Thank you.
Sorry, what do you...
Operating cash flow.
Operating cash flow,
Okay. So let me go one by one. On the deal pipeline, if we look at our pipeline, and therefore the sales pipeline that we continue to pursue with our customers, it actually moved up significantly. We, at the end of the financial year, previous financial, we were at about $1.2 million. We are touching already $1.7 million. Yeah. So that is the $1.7 million is onto the sales pipeline and all that. When it comes to the billing pipeline, I do not have the number upfront with me, but let me check and come back by the time I answer other questions. So I will answer that. Let me come back to the revenue first, the revenue normalization. The revenue normalization, as you know, it is the same account that we talked about and the same vertical that we talked about in the life sciences last time also. It is the planned normalization because generally when you have the large deal and when you have the run and change part at different times, when the project finishes, your revenue will get softened and get more steady going forward, and that is where we are. And we had to do that over the 2 quarters. We have done most of it already. It is only about $500,000 that is there, which probably we will do it in the next quarter, but we may actually be able to get that also. Okay, so but we were supposed to do that over 2 quarters, which finishes with the Q1, most of it. So that was the normalization. The third is onto the Microsoft. So Microsoft, we continue to do very well. In fact, now we have started getting revenue from Microsoft as a customer as well. Okay, so that is a good change that has happened in the last 3-4 months, where now we are not only discussing going to market with the offerings that are the Microsoft offering, but also going to Microsoft and delivering services to them. So we remain very, very upbeat on the Microsoft side, and I believe that we should be able to achieve our goals of being a $100 million partnership in time for us to really achieve that.
Yes, to your question on the operating cash flow, there are a couple of items. One, we spoke about the increase in receivables, both the billed and unbilled receivables. We spoke about that a little earlier. That was one item. The other, we also had lower financial liabilities coming from the fact that we had to pay out the variable performance incentive in the first quarter based on our performance in FY22. So net result of that is that we did have movement in working capital that caused a lower operating cash flow in Q1 versus the prior quarter.
What one should look OCF to EBITDA conversion, if you can provide some sense from full year perspective? Thank you.
Sorry, ask that question again, please.
OCF to EBITDA conversion, what is the right number or optimal number one should expect from Birlasoft on a full year basis?
Let me get back to you on that question, please. While we go ahead, I'll come back to you in a moment.
Dipesh, do you have any further questions?
No, thanks.
Thank you. We'll move to the next question from the line of Devang Bhatt from IDBI Capital. Please go ahead.
Yeah, hi. Thanks for taking my question. So, how much utilization can improve in the next quarter based on your deal ramp-ups? And what kind of subcon cost you expect to reduce? What kind of quantum of wage hikes in Q2 will be there in the impact? And is there any transition cost in the large deals that would impact the margin?
Sorry, just repeat the last line that you said.
So, is there any transition cost in the large deals that might impact the margins in the near term?
Okay. So, utilization, I believe that we should be able to come back to the levels that we used to be. Anything between 84 to 85% is something that we have delivered very consistently. So, I don't think that should be too much of an issue for us. When it comes to looking at the quantum of wage hike, I expect that it will be approximately closer to 3% average that we believe will be an impact due to the wage hike. There is some wage hike that we have done in parts for some of the people in order to retain them over a period of time. So that means that we will have to do it in such a way that we keep the impact to around 3%. Okay, so and then that plan is there in place, and I expect that anything from 2.5 to 3% is what we will get the impact on that frame, perspective. On the transition side, there will be a minor transition impact that might come. I don't think it will be a very significant one in the overall scheme of things. So they're not going to change it in the big way. Yes, we do have the transition for one of the deals that we are talking about, but I don't think there will be too much of an impact on that front because some of the costs that we had to take in order to create the plan have already been taken. Okay, so incremental will be not as much.
And how much subcon cost you expect to reduce? And secondly, if the macros turn worse, what percentage of revenue is susceptible to be impacted? I mean, what percentage of revenue will be impacted, do you think?
Sorry, can you ask the second question again, please?
So if the macros turn worse, what percentage of revenue you think would be impacted because of the macros, or there might be some halt to your, or there may be delay in, ramping up those kind of deals?
Okay. So Chandru here, let me answer the first question on reduction in your subcon cost. The expectation is that we will gradually improve on our subcon spending from the current levels of sub 16% of revenue. My expectation is that we should be able to shave off, at least 100 to 150 basis points, in Q2 and in Q3, right? Maybe Q3 will be a little less than Q2, but we should be able to shave off, 150 basis points over the next quarter or so.
Yeah, but one additional point that I will talk, which is more qualitative on the subcontractor side, is that traditionally we have always seen subcontractor to be very cost consuming and all that. But with this whole flip on the cost increasing across the board for on-site and offshore people, many a times we are seeing that the subcontractors are now either at par, and in some of the cases it is also lower because it is quicker to get them on project and off the project. Whereas with the employees, there is always a bench time that comes into the play. So I believe that over a period of time, I don't think that right now is the right time to really change the way we look at the subcontractors, but over a period of time, probably we will have to look at subcontractor in a way where we do the planning in such a way that it is a quick onboarding and offboarding, so that both the directions, when you end up losing the utilization when somebody is on board as an employee, you can actually save on that money. At the same time, this work from home is going to lead more and more people opting for the subcontractor. So we need to really improve our process, the way we manage that, and reduce the cost rather than just looking at the count of the subcontractors. So from that perspective also we are working on. So this is being looked at with a new lens, and I think it is very, very important that we look at with a new light actually. But we'll continue to come back as it is something that is emerging now, new reality for the business, and we may have to decide our benchmarks going forward accordingly.
Thank you. Devang, do you have any further questions?
Yeah, just the macro part, that what percentage of revenue can be impacted if the macro turns worse?
I'm sorry, I didn't catch
the question. Is what percentage of revenue drop do we expect if the macros turn worse?
I tell you, it is very difficult to say that. I hope that it doesn't turn for the worse, okay? But it is very difficult because, people talk about different range, and everybody has a theory, that how wrong it can go. In my opinion, there is not going to be one yardstick through which you can define, because it will be different for different industries. It will be different for different geos. It will be different for different companies within the same industries also. So it is very difficult to, right now say how much it will be the impact on us. We hope not. We hope that we continue to grow, the way we have planned, and there is no adverse impact it comes. But we are preparing ourselves for that for only one reason, keeping in mind that how can we reduce the impact on the margins in case that happens. So that's the focus area that we are looking at. But it is very difficult to really put a finger on what figure that would be.
Okay, thank you. Thank you for taking that.
There was a question on OCF, so I just thought I will quickly respond to that. The OCF number as we go forward for the rest of the year, to my mind, will clearly depend on a couple of things, right? One is, of course, managing our working capital, managing to make sure that we continue to drive higher collection, keep our receivables in check, and also make sure that we manage the unbilled component. As we spoke earlier. The ideal, of course, I would say ideal, of course, is 100%. But we will have to work through this for the rest of the year, given some of the headwinds we spoke about at the macro level. Do not see any concerns from a credit standpoint and from a receivable standpoint. I also think we'll have to look at what kind of AR days we end up having to sign up to with some of our newer clients in the new geographies where we are having a lot of push, particularly in Europe, where typically payment days are longer than in the US, but this is something that we'll continue to watch closely.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead. Sandeep Shah, your line has been
Thanks for the follow-up. Thanks for the follow-up. Just for the previous question, for the two delayed contracts, as we are in the first week of August, you said one of the delayed contracts has already started at the start of the quarter, and the another is yet to start, right? Is it the right understanding?
So the other one is yet to start, yes, correct.
Okay. And DK, in terms of enterprise solution, being recession could be a worry. Are you worried about your growth plans and the budgeting for the enterprise solution if recession happens? Because that could be termed as a discretionary IT spend for some of the clients as a whole.
No, I don't think so. In my opinion, the enterprise solutions, if you look at, slowly what is happening is that they are also becoming digital, and hence, their growth also is coming in the newer area of modernization. So everybody is going after the digitalization, and when anybody is doing in the span of the enterprise solution, then that continues to happen. So traditional solutions and all that, yes, it will be lesser growth overall because that will happen. But the newer area within the enterprise solutions, they are going as good as, digital, though the quantum may be much lesser than the overall digital pie that is there around us. Okay, and it also depends upon how and where you count the revenue. So I don't think that there should be too much of an issue. But on the traditional side, slowdown will always have an impact. But I believe that it will be limited and lesser than what we actually saw during the COVID times.
Okay. And just a clarification.
Yes.
And just a clarification, DK, what could have been a quantitative impact of these two deals got delayed? If they could have realized on time, how the growth could have looked like in the first quarter? And second, on a wage increase, the 2.5 to 3%, are you saying a margin impact in 2Q? Or are you saying it's an average wage hike to be given to the employees as a whole? And where are we in terms of the annuity revenues or a sticky revenues as a percentage to the total revenues, which we used to disclose earlier as a whole?
So the 2.5% to 3% was the not the margin impact, but it is percentage of the revenue. Is that right, Chandru, that we have that percentage that we computed?
Yes.
Yeah, it's the percentage of the revenue that is there. Okay. There are other factors through which we are improving it also. Okay, so that's a case on the revenue side. And when it comes to the deal, I believe that we could have got approximately $2 million of the revenue if it was going to start in time.
Okay. And in terms of annuity revenue?
Annuity revenue stands at 71%.
Okay. So we are slightly off track in terms of our target of 75%, which we were targeting by Q4 of FY23, right?
Yeah. So, what has happened is that now the deals that are coming, as we have, I think, taken that point multiple times, that the deals are shorter, okay, and the quicker deals and not the long-term deals. So from that perspective, it does have impact on the annuity revenue. And second, more and more digital deals and the transformation deals are becoming project-based. And in fact, this is being seen that the project revenue for almost every company has become more than what it used to be earlier. We thought that we should be able to reach at 75%, but I think 71% I always said is the ideal. I mean, 75% is ideal, but 71% is a good, percentage for us to continue to follow, and we remain at 71%.
Okay. Thanks and all the best.
Thank you. The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the follow-up. Deki, in between the remarks, you mentioned about, you have started providing services to Microsoft as a customer, and you are aspiring of roughly $100 million kind of a partnership here. Is this $100 million number include the earlier cloud Microsoft revenue that we were aspiring? Because that target was also $100 million. So are both of them similar or different? And also wanted to understand
it's different. 100 million is our revenue for that practice. Okay, it will include the revenue being sold to Microsoft as a client, plus the revenue that we sell on the services on the Microsoft platforms to any other customer. It includes everything, yeah.
Sure. So this $100 million number includes the Microsoft Cloud plus Microsoft as a customer.
That's right, yeah.
Yeah, sure. Okay. And just on the services side, what kind of services are we giving to Microsoft? Just any understanding on that?
So most of these are actually either on the Microsoft Dynamics side. It could be CRM, or it could be the other enterprise solutions that they have, and on the cloud as well.
Sure, yeah. That's it from my side. Thank you.
Yeah.
Thank you. This was the last question for today. I now hand the conference over to Mr. Dharmender Kapoor for closing comments.
Yeah. No, thank you very much, everyone, for your participation and the questions that you asked. Yes, we could have done better in the quarter one, but there are always going to be some times where there are unforeseen items that come in front of us. But we stay confident that from the capability perspective, from the client perspective, from the way we are winning the deals and how our pipeline has increased, we stay confident that we are on the right track. And I believe that that should give the confidence to us and to everyone around us that we will continue to do better. With that, I wish good luck to all of you as well as to us for the next quarter. Thank you very much.
Thank you very much. On behalf of Birlasoft Limited, that concludes this conference. Thank you for joining us, and you may now disconnect.